In 2016, I think we can expect to see the headline growth rate of Chinese GDP continuing to gently slow down. But we actually think that's a good thing, because the most important thing in China is the quality of the GDP growth rather than the quantity. And by that I mean, is the GDP being generated by sustainable domestic demand and consumption, or is it dependent on the old fixed asset investment debt-fueled model? And we obviously want to see that transition towards consumption taking place. Now, the recent 13th five-year plan that the Chinese government have released shows that their reform program is intact and is absolutely designed to make that shift towards consumption take place. And importantly in China, it's a very broad and deep market, and we're finding lots of really good companies for our portfolio managers to invest in, which have good business models, good management teams, and attractive valuations. India also looks like a great opportunity in 2016. I think you can argue that where China looks as if it's already made the easy money, India has yet to do so. And by that I mean that they're still capable of generating high levels of economic growth from building infrastructure. They also have a demographic tailwind from a rising population. So consensus economic forecasts already show India's economy growing faster than China's. Now, Prime Minister Modi seems to be doing all the right things. Some of his government targets look truly impressive. 100 million new jobs, 100 million new toilets, 65 million new homes, to name but a few. So these are all causes for great optimism. And like China, it's a very broad and deep stock market where our portfolio managers are able to find lots of really good quality companies to invest in at attractive valuations. The rest of the region is slightly less attractive, I would say, than China and India. Some of the ASEAN countries, for example, like Thailand and Malaysia, have some political or economic headwinds. But in general, we think that Asian emerging markets should outperform non-Asian emerging markets in 2016 because of their generally higher growth rates, their strong fiscal and current account surpluses, their high levels of foreign exchange reserves, and the fact that, generally speaking, they're commodity consumers rather than commodity producers. But it's really about the companies in Asia, I think, rather than the macro. This is what excites us. We have 16,000 listed companies in Asia, which is more than Europe and the US combined. And with 50 analysts turning over all of those stones, inevitably we're finding lots of really good companies to invest in Asia with good business models, trustworthy management teams, and attractive valuations.